So, would you place a bet on China-backed SMIC to win the semiconductor race? Well, welcome to the Valuation Masterclass case study, where you'll learn about interesting stocks and how to value them. What's interesting about SMIC is that it's the fifth largest chip maker in the world. This is Andrew Stotz of the Valuation Masterclass. Let's get started. Remember, this information is for learning purposes only. This is not investment advice or recommendation. Would you place a bet on this company? Well, SMIC is in the infotech sector, and it's China's largest pure play semiconductor foundry, which is partially state-owned. There's three things to know about the company. First, semiconductors are the next battleground of the US-China tech war, backed by Chinese government, but facing tough competition. And aggressive expansion requires heavy investments. Let's look at some key statistics where I think it will be interesting. First, there's 26 analysts covering the company, and of course, it's trading in the Hong Kong market, and the upside is 50%. It's a massive buy. The PE ratio is 110, and dividend yield is 0. So, what's my valuation? Well, my estimate is about 14, which is a 16% downside, and would make it a sell. If you have any questions or comments, you know this company well, feel free to let me know what you think. Also, I welcome everybody onto this stream. I see Jonathan, nice to see you there on LinkedIn, and others who are joining from other platforms such as Facebook and YouTube. Feel free to ask any questions. So let's look at the sales or revenue of this company. First thing, revenue breakdown for 2021. This is by applications. Where are the chips going? 32% are going to smartphones. 24% are going to consumer electronics, 13% are going to smart home devices, and 32% is going to others. 64% of revenue comes from China, 22% from North America, and Europe and Asia, 14%. Let's talk about the story. Again, welcome everybody. If you have any questions along the way, or if you have any knowledge you'd like to share, feel free to type that into the chat. Tarin Rat, nice to see you. Welcome. Now, the first thing we have to look at is, well, why do these analysts have a 50% upside? Part of it, and I know having been an analyst during my youth, is that basically sometimes you have a buy on a company and then the share price collapses and then you get a huge upside. So the steady fall in the price has caught analysts off guard, leading to their 50% upside. And I suspect that they might adjust their target prices down. So semiconductors are the next battleground of the U.S. tech war with China. In 2020, the U.S. government placed SMIC on the entity list, which bans the export of U.S. technology to the companies on the list. At the time, it was the Trump administration, and former U.S. Secretary of Commerce Wilbur Ross said, "We will not allow advanced U.S. technology to help build the military of an increasingly belligerent adversary." Again, it comes as no surprise, as I've highlighted in other presentations, that the U.S. has openly stated that China is its number one opponent militarily. I don't like the way that they're doing it, but I can't do anything about it. Now, the domestic market provides ample growth opportunities. Between 2017 and 2021, the share of revenue from North America has been cut in half, from 40 down to just 19%. However, that doesn't hamper the growth prospects of SMIC, as the Chinese demand for chips is rising at an enormous pace. And I haven't been to China for a while, but I know every time I'm there, things are going so fast. Given the supply shortages, we expect SMIC to continue delivering high double-digit growth. So let's talk about the next point number 2 in my story, and that is that it's backed by the Chinese government, but also still facing tough competition. China attempts to become self-sufficient in semiconductors for domestic consumption. In 2021, the Chinese government supported the development of a new factory in Shenzhen worth $2.3 billion. It aims to ramp up self-sufficiency rate to 70% within 5 years. Currently, it's at 20%. So China is massively expanding this area. To reach that goal, SMIC secured several fundings from the government to accelerate the rollout of new factories. On top of that, China granted a corporate tax income break for 10 years. So they're basically giving every possible advantage they can to the company right now, as well as having some shareholding in the company. Let's look at this. The title at this page is "Long Way to Go to Close the Gap to the Taiwanese Leader, TSMC." With a market share of around 57%, TSMC dominates the foundry market. Also, having top U.S. companies as customers secures its #1 rank. Despite the massive ramp up of SMIC, it might take very long to converge to the profitability level of TSMC. In fact, let's just look at that for a moment. Over the past 5 years, the revenue growth has been a little bit higher at SMIC, but not by a huge amount. But gross margin has been about 50% for TSMC versus 24% for SMIC. Now, over that 5-year period, we did have some difficult times and some losses at the EBIT level. So when we average out the EBIT margin, we get a very low 6.1%. The ROE is about 6.5 compared to about 29% for TSMC, and ROIC again is about 3 times higher at SMC, more than 3 times higher. So SMC is clearly TSMC is clearly a powerhouse when it comes to business and profitability, and SMIC's got a long way to go to get to that point. Now, number 3 is aggressive expansion requires heavy investments. I expect the company to continue spending massively on the rollout of its production capacity. Here we can see a bar chart, a stacked bar chart showing the CapEx and R&D. And basically what you can see is that in 2020, CapEx exploded and it's been high ever since. Between CapEx and R&D, they spent almost $6 billion in 2020, and that compares to about 2.5 in the prior year. This obviously part of that had to do when Trump was in office prior in 2019 and 2018. He was basically building a somewhat of a hostile relationship between US and China. And so eventually they saw they had to start ramping up. But it might take a while until SMIC generates enough cash flow to internally cover its investments. Free cash flow of the firm is likely to stay negative in the short run. Let's look at the forecast. Consensus is divided. There's 26 analysts. They have an upside of 50%, but 13 analysts have issued a buy recommendation. Many analysts stay cautious or a hold at 10. So it's a lot there. It's a mixed bag. Analysts predict stronger gross margin, but a decline in net margin over time. This is in line with our forecast due to increasing R&D expenses, which are captured in SG&A. So let's review some of the financials here. Despite strong revenue growth, we are likely to see stagnant net profit due to an increase in R&D and SG&A. And also, net fixed assets continue to grow at a rapid pace as SMIC expands aggressively. So this is a company, despite the fact that it's growing its net fixed assets very strongly, it also has a lot of cash. As at the end of 2021, it had $12 billion in cash compared to $36 billion. So a third of its assets, $36 billion in cash for total assets, a third of its assets in cash, and about an equal amount is in net fixed assets. SMIC has moderately low leverage, and being backed by the Chinese government means relatively low financial risks. And here we can see the effective tax rate is now down to about 4%. We're forecasting about 7% right now. The company holds 1/3 of its assets in cash, making the net debt to equity ratio negative. In other words, they can finance their growth. So if you want to learn how to value companies like this, join my 6-week valuation masterclass boot camp. You'll learn practical valuation skills by valuing actual companies. You'll access my tools, tips, and tricks, and you'll join a group of inspiring financial professionals. And hopefully you'll get a job through my network of finance industry leaders. The next boot camps are scheduled for July 25th, October 10th, and January 9th. I'd love to see you in there. Join for just $797. Scan this QR code to learn more, or just go to valuationmasterclass.com/bootcamp. Let's continue on. Let's look at valuation. I have a Stocks investment research stock picking checklist that's inspired by Peter Lynch's book, One Up on Wall Street. In fact, it's right here. Never goes away from me. One Up on Wall Street. What an amazing book. Now, he talked about 10 baggers, meaning stocks that go up 10 times there. We did extensive research on 10 baggers and found 9 factors that drive long-term share price performance. So let's go through these 9 factors with relation to SMIC and think about, could this be a 10 bagger? The first one is management is committed to growth. That's a good one. Over the past 10 years, revenue has grown at a CAGR of about 15%. Number 2, growth can hit double digits, like it's possible. That's good. Given the supply shortage of chips, there's still plenty of excess demand. Number 3, gross margin can remain high. That's good. There's strong potential to converge gross margin close to its peers. In fact, this is an interesting point. They've got revenue growth, and if they have margin improvement, then they're going to drive a lot of EPS growth. Let's look at number 4. Earnings are predictable. This is moderate because there are fluctuating exceptional items. Number 5, efficient at deploying assets. This is weak. The asset turnover is 21%, which is much weaker than its peers, meaning for every 100 that it invests in assets, it's generating about 21 in revenue. That's not uncommon for their type of heavy industry, but if they can improve that, it would be great for profitability. Number 6, cash conversion cycle is low. This is moderate. Cash conversion cycle is 22 days, comparable to the sector average. Number 7, cash flow is consistently positive. That's weak. SMIC's operating cash flow is far lower than its investing cash flow as it expands aggressively. And number 8, capital is readily available. This is good. The company's net cash, and with the support of the Chinese government, they're probably going to be able to access. And number 9, valuation is reasonable. This is weak. It trades on high PE and price to book. So the conclusion, can this be a 10 bagger? I would say it's possible to be a 4 bagger for this particular company. Now let's look at the free cash flow, which we can see the heavy capex required means that the company is likely seeing negative free cash flow to the firm right now. However, I think that the company can deliver a positive free cash flow to the firm in 2024 for the first time. So let's look at my value estimate. Similar to consensus, I expect the SMC can realize its growth potential. Plus, I assume the SMIC can increase its ROIC to 20% from 7% over the next decade. So again, here's a company with good growth and the potential to improve its margins. So it is interesting story, but it may just be already in the price. I've used a free cash flow method, market risk-free rate of about 1.7, equity risk premium of 6%, market return of about 8. My beta is 1. So the cost of equity is 7.7. The WACC is 7.1. So not much difference because there's no debt. And the terminal growth rate I'm going to use is 4%. What do I come up with? $14 Hong Kong dollars, which is a downside of 14%. The bull case is down 0 and the bear case is down 23%. What are the risks? Well, the key risk is geopolitical conflict. Geopolitical situation may put the company's access to raw materials and equipment at risk, and change in preferential tax policy could adversely affect the company's bottom line. If the Chinese government did something about its tax breaks, that would be very painful. And failure to keep up with technological changes and falling behind competitors is the other one. So what are the conclusions? Double-digit growth and backing from the Chinese government, aggressive expansion plans could lead to ongoing negative free cash flow. We're saying it could go positive in 2024. And placing a bet on SMIC might turn out fruitful, but it's a risky bet. So the question is, would you place a bet on China-backed SMIC to win the semiconductor race? Let me know your ideas, your questions, and your comments in the chat. Have a great